All right, Bruce, let's check if we're live. Do you see that we're live? I think we are.
Not yet. Not yet, but it usually takes just a bit before it goes.
All right, I think we are now.
There it goes. Yeah.
Awesome, awesome. Well, welcome back to the Money Advantage podcast. This is Rachel Marshall and Bruce Wehner, and today we are talking about RPU, reduced paid up insurance. And this is really the safety net built into whole life insurance. So before we get too deep into this conversation, I want you to know that sometimes the most effective safety mechanisms are the ones you never need to use. Honestly, the first thing that comes to my mind is that all the whole spiel that happens in an airplane when you are getting ready to take off about how to access the oxygen mask and how to access the cushion under your seat and what to do with the emergency release door if you need to access any of these tools during an emergency. And yet, the number of times I've flown, we've never had to use any of them. I'm so thankful that they exist, and I'm thankful for the process that is in place for that. And so, today we're talking about reduced paid up, this component that is buried into a whole life insurance policy most people don't think of until they need it. And it's really important to be prepared and understand the safety mechanism, not because it's ideal to use, but because it gives you the peace of mind of knowing what options you have in case something goes not the way you planned with a whole life insurance policy. Bruce, thank you for joining me for this conversation today. And I'd love to hear your thoughts as we're framing this conversation before we get into what it is and how it works and when you might want to use it and all of those details that we'll cover today.
Um, well, first of all, I'd like to say that we are going to talk about things, excuse me, in general, but there may be some products out there that have some different parts of their contract that may not be what we are just talking about in general. So I just want the audience to understand that what we're talking about happens more than 90% of the time, but there could be some one-off contracts out there that are different. So I want people to understand that. That's why, but then that brings me to the second point of this is the things we're talking about are contractual. That means that they are in the contract and they are something that you can take advantage of. Now, as Rachel said, we do not think, especially if you're going to utilize whole life insurance as a for the banking function of your life, there wouldn't be a reason to actually ever RPU a policy. Because just like you're not going to stop putting money in the bank, then why would you stop putting money into a life insurance contract? Interestingly enough, Rachel, we had one of the Money Advantage's long clients of about 9 years now, one of our first clients, and he emailed me just a couple of days ago and asked me, and his father was in the life insurance business, so he knows more than kind of the general public. And he said he'd like to see his policies RPU'd, reduced paid up at age 65. And so we ran a couple of scenarios for him. And when he got them back just this morning, he emailed me back and says, "Oh, that's interesting, but I don't know why I would ever stop paying into the policies." And so
That encapsulates
what
the whole podcast today. We might just stop there. Just kidding.
well, I think that does bring into the point that once you get to a point where you realize that when you make a premium payment and once the money clears the banking system, the commercial banking system,
Hmm.
not the banking system that you're putting together with the whole life insurance contracts, um, once you get to a point where that money is all available to you within a couple of weeks, then it's you get to the point where you're saying, well, why wouldn't I put this and get all the other benefits of this? But I think for today's purpose is we're trying to tell you that this is part of the contract, a whole life contract. Now, I have had people challenge me and say, well, you can do the same thing with a universal life policy, whether it's a traditional universal life or a variable universal life or a a index universal life. And these are commonly referred to as non-forfeiture options. And common non-forfeiture options are the first one, which I always found to be very odd because they say you can take the cash value. Well, what they mean is you're not forfeiting the cash value. You are forfeiting the contract, but you're not forfeiting the cash value. You can, in a universal life policy, you can reduce the death benefits, but it doesn't mean contractually that the death benefit will be guaranteed to continue forever. You can reduce the death benefit so that you don't have to put in any more um, premiums, but the index still has to perform, or the mutual funds, the sub accounts have to still perform.
Mm.
The interest rates have to still perform. And then this is very common in whole life where it's called extended term. So you can just stop paying the premiums, and then any cash value you have will actually purchase a term policy for you, and it will be guaranteed not to lapse during that time period. Very few I have heard some universal lives having it. I haven't seen one in a long time. They do not offer in the contract an extended term, which would be another non-forfeiture option. I'm not saying they don't exist anymore. I'm just saying I have not seen those in quite a while. So what we're talking about, I want to clarify this for the audience. We're talking about what the insurance industry um, says is a non-forfeiture option. In other words, what is another option you have instead of just paying the premium? And the one we're talking about today is to reduce the death benefit on a whole life insurance contract based upon how much cash value you currently have and based upon the age that you currently are, that you do not have to put any more premiums and it will not lapse. And then we'll get into some more details if you want to add anything to that.
One question, Bruce. So back to the universal life policies, you said that the cash value as a non-forfeiture option could be, you could reduce the death benefit. You said which would guarantee that the no more premium is due for that death benefit, but you said the index still needs to perform. What if it doesn't? So if the index doesn't perform and you're not paying any more premium, then at that point the death benefit reduces. Is that correct? Further?
Well, the death benefit could either it depends on when you catch it. If it goes all the way
Okay.
to lapse, they could come back and say, well, in order for it not to lapse, you can continue to pay the premium, or you could put a lump sum of money into it.
Okay. So
Okay,
meaning
so
again, there's fewer guarantees. Even if you did this option of reducing the death benefit, that's not a guarantee. You're going to keep that level of death benefit and never have any new capital due to maintain the policy on the
now
IU.
there are guaranteed universal life provisions in there that says that we will guarantee this if you make the premium payments at a certain period of time. We will guarantee this. It's kind of like on a term chassis. The problem is we would never use those in the infinite banking world because the cash value growth in those is very minimal because they are looking at those long terms as being guaranteed. Now there are some once again there are some issues with the word guaranteed because if you go past the grace period, they can change the guarantee, so on and so forth. But I don't think we're here today to talk about the IUL portion of it. But just to know that the reduced paid up is not the same within an IUL as it is within whole life.
So today we're talking about whole life insurance specifically. That's all we're going to say about the IULs. So specifically about whole life insurance, what we're looking at today is I've heard it said way back in the beginning of my time working with life insurance. I think the number one concern that I heard from somebody was, look, what if this premium is due and I don't have the money to pay the premium? And if I'm in that situation, What are the choices? What are the options? And so sometimes it can be a little bit unnerving for somebody to say, I'm making a commitment that starts today, that I'm literally committing to making this payment on an ongoing basis for as long as possible. I say that some people could find that unnerving. I would also say all of the commitments that you make that are the longest range commitments are probably the ones that you have to fight for the most and the ones that are the most worth it. I believe marriage is a lifelong commitment. It's not a, well, things got a little rocky, so I'm out. I think if more people looked at their lifetime commitments in that way, we would probably not have so much concern about making long-term commitments. But then there's the nature that life changes. Hardship comes, economic times, business, fluctuates, income changes. And so when you're getting into starting a whole life policy, it's really helpful at the forefront to understand what are the options if things do get rocky. What are the parachutes? What can I do without having to cancel this policy? Because here's the way I hear the word non-forfeiture, all the things that I can do without having to give up the contract. So without having to completely just cancel out the contract, dissolve it, and have no death benefit, no cash value anymore. Most people who start a whole life insurance policy want that to keep going and have full intention to keep that going as long as possible. And so there are multiple options to not have to forfeit a policy, have to not have to surrender or give up a policy. So, Bruce, I know we've covered this before in a previous episode. Could you just really, really quickly kind of go over maybe all of those options if somebody was in a situation of saying, look, premium is due, that deadline is coming up in 3, 4 months ahead. I know I'm not going to be able to pay it. What are the options that I can have to keep this contract going without having to make a payment out of cash I don't have and without having to give up the contract?
Yeah. So let's first of all, let's just say that this is the contract. And so you control the when you actually pull the trigger on different things in the contract. So the reason what Rachel's saying is you don't want the reduced paid up to be the first trigger that you pull in the contract. Because when you do reduce pay up, it's exactly what it says. You're reducing the death benefit to the point that the cash value, that cash value will be like a single premium. It purchases that amount of death benefits, and you're not required to make any more premiums. And not only are you not required, or you cannot make any additional premiums. So the policy is paid up, and you cannot change it as far as putting additional premiums in it. So that's why this should be the last line of defense for a client. So I wanted to emphasize the fact that you can't change that. You can't say, well, next year I will have this. Now, what can you do
So really
to
quick,
keep
Bruce,
the
since you basically defined what reduced paid up is, I just want to clarify, not add anything to what you said, but just to clarify, reduced paying up is literally taking the current amount of cash value that you have available to you right now and using that to purchase a smaller, fully paid up policy which never requires additional cash in the form of premium to maintain. So what it will do is it does not cancel a policy, does not surrender or give up or forfeit a policy. It keeps a policy going, but it takes the cash value, purchases a lesser death benefit, so the death benefit drops. The cash value stays the same, is that correct?
Mhm.
The cash value stays the same, the death benefit drops, and no new premium is due, nor can any new premium be paid. So reduced, just to clarify, that is reducing the death benefit coverage. It also requires no new premium ever again. And it's not reducing the quality of the coverage, it's just reducing the amount of death benefit coverage. Anything else you want to say in terms of defining reduced paid up? Because I realized that we hadn't done that. You did well before we go into the other options.
Yeah, I would just say that the death benefit will continue to grow if you have chosen, this is the way we always do it. Dividends will purchase more additional paid up insurance. So the death benefit will grow. However, it will grow much more slowly because the dividend will actually decrease from the previous dividend. And the reason it decreases, not the crediting rate necessarily, but the volume of the dividend will decrease because the dividend calculation is based upon, in some respects, to how high or how large the death benefit is. And so if that death benefit is smaller, then the dividend is going to be smaller. So it will continue to um, increase the death benefit, and it will increase the cash value from the guaranteed interest and dividends. It just will not do it as fast as it was doing it before because obviously there's less premium, there's less death benefit. And if death benefit is part of the calculation, then it will not increase as fast because the dividend is not as large. Now, let's pivot to what can a person do before they reduce pay up. And the first thing that we suggest doing is that they would actually surrender paid up additions. And we talked about this in other episodes, but paid up additions are just what it sounds like. It's part of the contract, not the base contract. The base contract is for the death benefit that is going to be paid throughout the entire life of the contract. Paid up additions are optional to be paid. So then what we say to the client is, okay, you have a $30,000 premium payment coming up. Can you pay any portion of that? So we would ask them because they might think they have to pay the entire 30,000, even though we've tried to make this clear to them before that they don't. So we say, can you make the base and the term portion of it? And in a lot of cases, they can make a partial payment. So then you can just make the partial payment, and then in the future, you can catch up for the PUA payment that you didn't make.
So
Okay,
that would have an
that's
advantage of being able to say, this is a hard year, hard season. We're going to reduce what we were intending to pay, not pay the full premium, pay the required premium, but not the full paid up edition, and later still be able to pay the full premium in future years, but also catch up the PUA from that year you didn't pay it fully,
correct.
which means you
And
have
then,
more capability of putting in more premium.
and then timing wise, we may say to them, well, can you pay the full premium if you then can take a loan against it in about 12 days and then replenish what you were going to use that cash for? And depending on where you are in the contract years, that could be as close as 100% of that money will be available after about 12 days. Now, I'm using 12 days as a guideline. It depends on the carrier, it depends on the commercial banks, so on and so forth. But if they say, well, I don't need it immediately, but I have this project that I have to pay for in 30 days, but they say, I don't want to make my premium payment because I need that cash to make for this project. And I say, well, then why don't we make the premium payment and then we take a loan against it, and you'll get the money back in about 12 days and see if that's an option for them. This
And what's
doesn't happen
caused
very often, but that is an option.
and Bruce, you and I have had several conversations, and I know we've brought this up on the podcast as well. It's better to pay your full premium and take a loan because the whole amount of cash value is continuing to grow rather than paying less premium and not taking a loan because you have less cash value that's able to grow. Is there anything you want to add to that or further clarify?
Well, it also increases the death benefit, and the death benefit increases and increases future dividends, so on and so forth. So there's a lot of reasons to do that. So that would be so we're having conversations with the client. Those are the first two conversations with the client. Can you make a partial premium payment, and which would be the base in the term, and can you make a premium payment, and then we could take a loan against the policy. The next part is we could actually just take a loan against, if they do not have any capital whatsoever, we could take a loan against the policy and use that loan to then make the premium payment. either the entire premium payment or a partial premium payment. So that would be one thing we could do. We could actually the next thing you do is you actually use the dividend to make a partial or a whole premium payments. And then the and then I know I started to talk about the PUA surrender, but I'm not sure if I finished the PUA surrender. But but the
Let's finish that.
PUA the PUA surrender is actually the first thing that we would look at, and the PUA surrender is a surrender where you're going to reduce the death benefit by just a little bit, because you purchased more death benefit in the past. You could you could surrender that death benefit. And let's say you have $1 million death benefit, and you're a 50-year-old, and the year before you had a $15,000 PUA payment, and it bought you an additional $30,000 of life insurance. We could tell the life insurance company we would like to surrender that $30,000 of life insurance that we purchased last year, and they will credit you the $15,000 to go towards your premium payments. So you're only giving up about $30,000 of your death benefit. Now, the disadvantage of that is you cannot get that back into the future, but it also doesn't mean you have to come to the table with any cash. You don't
But
have to
also,
surrender your dividend, because if you surrender your dividend, you're also not getting any future compounding on the dividend.
okay, so but in that case, if you're surrendering a PUA, Bruce, every year going forward, I still could continue to pay my full premium payment, including my full PUAs. Is that correct?
I'm sorry, I was reading one of our comments on there.
Okay, so if I surrender a PUA though in 1 year that is a challenging year, I still can pay my full PUAs every year going
Oh,
forward.
sure. Yes, absolutely. Yeah, you haven't changed the contract whatsoever. You haven't changed the
Excellent.
contract. We have some really great questions today. I think social media insurance bro, if you don't mind, I'll leave your question answered towards the end, but I am going to read it right now. It says, how do you deal with CFPs and RIA crowd who are anti-civil towards their and your potential clients, usually on LinkedIn? So this is interesting. I'll deal with that in just a little bit. But for the sake of continuity, I want to go to Fritz's question, or comment, and I agree with Fritz 100%. He says, "Get those premiums in. You will never regret the capital it generates. BlackRock is currently freezing withdrawals. Your cash value never freezes." Now, Fritz, and Rachel and I have always had the idea that we're always going to have full disclosure. Full disclosure. Cash value will never be frozen, but there is within a whole life contract. They can freeze your access to loans up to 6 months in a Great Depression type of situation. Um, and I don't even know if it happened during the Great Depression, but that is contractual in that situation. Um, so let's go back to the what other options that you have into the future. Is the reason that you would want to not RPU is because oftentimes people are just going through a little blip in their personal economy life or their business economy life, and things will change for the next year. Now we do try to tell people that this is replacing the banking function in your life. So why would you ever stop making premium payments? But the human emotions take over, and so they look at all these numbers on a piece of paper, and they say, "Oh man, how can I continue to make these premium payments?" So we will have two different illustrations for them. One where they're going to make premium payments throughout the entire contract, and then one that shows what a reduced paid up means, so that they actually see it on a piece of paper, so that they can kind of emotionally categorize it in their brain and
Mm-hmm.
say, okay, this is true contractually.
So, a couple things I want to discuss about the reduced paid up option and really how it works are that, Bruce, when the cash value is used to purchase death benefit, I'm just going to state this and I want to make sure that you can add any clarification to this. So, the death benefit is recalculated then. So, it is reduced death benefit based on the current age. So, the new age that you are right now, not the age that you were when you started the policy. Also, the cash value available, meaning more cash value is going to purchase more death benefit, less cash value. So earlier in the policy is going to purchase less death benefit, but it's also going to be recalculated based on the original policy structure. And what I want to bring up here at this point is that you're still having a policy working, but if you reduce pay up, there's two things that I want you to speak to, Bruce. One is you need to be aware that this could cause ramifications in the tax structure of the policy. You could mech a policy if you try to reduce pay up too early, I believe. But I'd
Yes.
like you to talk to that. Secondly, reduce paying up is something that you would decide at that time. You don't start a policy with the intention to reduce pay up at a certain date and structure for that. What you do is you start a policy that you intend to fully fund, and then at some point in the future, you can decide to reduce pay up. Just know that it is that kind of safety or parachute. And thirdly, Bruce, I can come back to these points if you want. But third, if you were thinking of how the policy was originally going to be designed and what it's going to function like and how much cash value you're going to have and what your death benefit is and what your dividends are looking like, knowing that your initial illustration is just a projection, you have to recognize that you're not going to have that same level of capacity and growth if you're reduced paying up. It's like the policy is still happening, but it's at idle speed. So it's not stopping, it's still in effect. Growth is still going to happen, but it's going to be a lot slower. So, Bruce, really those three things are, well, I don't know if I can remember
Well,
all
I
three of
well
them.
I can start with the one that I think kind of encompasses everything. Is you said you should not do a policy with the intent of reduced paid up, especially early in the policy. And the reason for that is the modified endowment contract laws have a 1 year rule and a 7 year rule. And and so they look at how much you can put in any given year and then how much you can put in over a 7 year period. But they also have a little caveat. They say, or if there's a material change to the contract. So a material change to the contract would be obviously putting more money into it than it was illustrated. That would be a material change. And so it would become a modified endowment contract, which once again isn't always terrible. It just means that now the growth will become tax deferred and then taxable on a capital gains basis, or you when you access money through policy loans, it becomes taxable. Now, the way that you're talking about, that's the one material change, but the way you're talking about is if like in year 2 or 3, the person says, I don't want to do this anymore, or I can't do this anymore. I just want to do whatever I can to keep it going, but I don't want to put any more premium payments in it. And they reduce pay up in year 2 or year 3. Now they put more money in, and that term rider or that blended term, this is where you were talking about based upon the policy design at the beginning, that term or blended term leaves the policy, reducing the death benefit even more early in the policy relative to how high the death benefit gets by continuing to buy more paid up additions. So that's a material change. And that could actually mech the policy in that situation, especially if you would have had loans against the cash value at that time. And what I found in the past is if a person um, has to do a reduced paid up, it's because they didn't think long range. They did not have good money habits. They actually took a lot of loans against the policy and didn't pay them back. And all those things affect the death benefit. And if the death benefit gets too low and you put money into the policy, the contract early, and then remove that term because you do a reduced paid up, then it has a possibility of mecking. Now, the fact of the matter is you're not even above cost basis at that time, so you're not going to it's not going to affect you tax wise in that situation, but it could affect you as if you wanted to access whatever cash value you still had in there. It might be taxable, but it's probably going to be so small it's not even going to be an issue for most people. But it is contractually an issue. Contractually, it's an issue.
I
Uh,
think it is.
this is one of the things I say all the time to people. We're going to design these based upon your personal and business economy 100% that you feel good for 7 years. I want you to feel good for 7 years. Now, I think we've looked at so many of these over our career that we're actually looking at it throughout their entire lifetime, but people can't visualize that they're going to continue to make more money and more money and more money and have more capital. But so we focus on 7 years and also 7 years because many of the many of the carriers actually say that the paid up additions rider has to be maximized for the first 7 years, or they'll reduce how much you can put in future years.
But I want to point out that it's different to decide to reduce pay up in set year 7, 8, 9, 10. That's much different than setting up a policy as a 7 pay or a 10 pay policy to begin with, because at that point, the structure is totally different. Can you speak to that for a minute?
Yeah, and I will say that even though that we do not recommend those, if a person just emotionally cannot get past that, we're still there to do what's best. Well, I wouldn't say but what's best for the client, but what the client wants. So if the client understands that this is not the ideal design, but they only want to pay for 10 years, we will actually design it for 10 years and show a reduced paid up situation. Now, the problem with that is that I found over my career when you do that, when you design it like that, then you are designing it in a way that you can no longer put money in after that. Well, then after 10 years, a person really likes it, but now the term rider that was put on for only 10 years is not enough to sustain the policy without mecking it. Now they can still put the base premium into the policy, but now they cannot continue to fund the policy the same way. Now, depending on the carrier, you can now take that term and convert it to a new policy without any medical underwriting. So there are ways to get around this, but you would want to try to do it and maximize the efficiency because the new policy now will start the liquidity function over again. So trying to maximize the first policy you get without having any negative thoughts about RPUing is why having conversations with your agent is really, really important.
Super, super helpful. Okay, so let's talk about what happens to the cash value if you do exercise the option to reduce payout.
Good. I
So
was going to bring that
go
up.
ahead.
Good. So the cash value remains the same and then will grow, as I said, more slowly because we've reduced the death benefit, but the dividend and guaranteed interest keeps going. So the cash value is actually going to grow too. Now, and you still have contractual legal access to that cash value in the form of loans, and you can pay those loans back. It's just that it will not grow as fast because you cannot put any more premiums in, but you still have the same contractual right to loans and paying loans back as you did before.
Excellent. Okay. So now let's talk about um, we we talked about some non-forfeiture options. But let's talk about not ways, I don't even know if this would be non-forfeiture options, but what are other options besides reduce paying up? And what are kind of the pros and cons of that? So I'm just going to kind of lay this out for a second. So you're in a situation where it's difficult to pay premium either because there's less income or higher level of expenses or something that you, as Bruce mentioned, have an expense that you have to pay upcoming soon that you need your cash to be designated for that rather than for the life insurance. And so somebody might be coming into making a decision not to say let's keep the policy in force, but let's surrender the policy completely. So let's give up the policy. Let's talk about the pros and cons of that. Then we have reduce paying up. What we're talking about here is an option to not have to give up the policy. But then also, Bruce, let's talk about what extended term is. So, kind of that landscape of options in what to do if I can't pay premium. I know we talked about ways that we can keep the policy in force, but can you lay out what happens if I do give up the policy?
Well, if you give up the policy, you give up the death benefits, and that's valuable, especially as you get closer to mortality. People believe that's valuable. So one of the things Rachel's saying is that you could, instead of just giving it up completely, you could go to extended term. And what that simply means is whatever cash value you have in that left, instead of just having them surrender it and sending that cash value to you, you could just tell the company, I want that cash value to buy me in a term and extend this contract a certain amount of periods, whether it's 10 years, 20 years, 30 years, what this will sustain this cash value as far as like a term premium payment. So that is, if a person is trying to maintain the death benefit for a period of time, that would be a better option than just to have them send back whatever cash value is still in the policy.
So if you did an extended term, do you determine the length of the term or does the insurance company determine that?
Well, it can be that obviously the insurance company will give you options. Yes,
Sure.
it will,
Okay.
and you can pick those options.
And if you use the extended term option, you have a death benefit, but not cash value.
Correct. Correct. In that case, it's not reduced paid up whole life insurance. It's extended term, and there's no more cash value. They're using the cash value completely to pay the term for a period of time. There's no more premiums due, but you cannot say, well, I want this back now. You paid up a term policy.
Which in that case would mean I don't have access to cash value. And when the term runs out, say it was 20 years and I'm now outliving the 20 years, now I don't have life insurance at all at that time.
Yeah, and the reason you might do that instead of the reduced paid up is the death benefit will stay higher than a reduced paid up. So if the death
So,
benefit is
yes.
really, really important to you, then that would probably what you would choose.
Okay. Okay. But reduce paying up of those options of giving up the policy altogether, which would mean you have the cash value paid out to you, no more death benefit, policy ends, or extended term, meaning your cash value purchases a long or a term life insurance policy. The one of those options that's reduced paid up that we've been discussing this whole um, session today is that that's going to preserve the most long-term value, specifically because you are maintaining a long-term policy and you're also maintaining cash value and access to that cash value. Is there anything else that needs to be said about that? I just want to make sure that those options are clear.
No, I think that's fine.
Okay. Bruce, is there anything else we need to talk about in terms of what kinds of situations somebody might elect to reduce pay up? I know we've kind of talked before about maybe cash is tight or there's an expense upcoming. What other circumstances have you seen where maybe somebody has chosen to reduce pay up or where it might make sense? We're not advising that this is the thing to do, but where it might potentially be on someone's mind that this could be a solution for.
Well, I think the most common one that comes up is people really can't see the fact that this is a banking function and they could make their premium payment in 30 days, between 12 and 30 days guaranteed, they could actually borrow against this to for their banking functions in their lives. And they say, I don't want to do this after I'm retired. That is the most common reason person says, I want to see a reduced paid up or I don't want to make premium payments anymore. People usually bring that up at the very beginning. What do you mean I'm going to be making premium payments till I'm 95? I'm going to be retired at 65. How can I make those premium payments? And then we have to talk through them about either cash flows that's going to be the same and you can still make it as you do now, or you can say you got this asset over here that you're not going to be using in retirement, what are you going to do with this asset? Oh, well, I'm just going to leave that to my heirs. Well, if you're going to leave 200,000 to your heirs, wouldn't it be better if we show you to put this in as a premium payment, and that premium payment then leaves an additional 400,000 of tax-free death benefit to your heirs? So sometimes it's just not knowing what you don't know, um, causes the person to say, yeah, it doesn't make any sense to reduce pay up.
Bruce, I love that you brought up that idea of not knowing what you don't know. I think some people are afraid of that. They realize there's a lot of things I don't know, and there's a lot of things that I wish I could see. I think what is really valuable is understanding that there are people like Bruce, like our team, that can help you think strategically to not feel like you are stuck. I think that's the number one reason why people make poor decisions is because they feel stuck. They don't recognize their options. They don't know what could be done because maybe they're thinking one way about the use of something. They're only seeing it from one perspective when something could be strategically used differently and actually be so much better for them. And so, Bruce, I just love that you brought that example up.
Yeah, and in respect to we're coming into our normal close, so in respect to the time, I'd like to address a couple of questions, and I'm going to get to the one that I put off earlier. But Warren Barnes says, please address the situation whereby somebody decides to fully consume a policy in retirement as a personal pension. In that situation, might it be helpful to first eliminate the premium drag? The short answer is yes, it may. It may be. It's going to determine how long you've actually made those premium payments, how much you need to make it as a personal pension. And as Warren's saying, I think he's saying he's going to maximize it to where it's going to be basically, the loan against the policy is going to continue to be a drag on the death benefit, and at the very end, there's going to be little death benefit available in that situation. So that could be a situation where not you would essentially be having not as much death benefit, just like a reduced paid up, but that's a whole different scenario where you're planning to use the cash value. So that
Bruce,
is
in that question, I'm seeing also the premium drag, and Warren, you might be meaning it in multiple ways, but I'm thinking if I'm going to use or fully use up the cash value in terms of income, I would need to take more income if I were going to take enough income to live and also make the premium payment. So he could be thinking of it from that perspective as well. I need to take less
correct,
out if I'm not also making
correct.
a full
But then you
payment.
can also look at it in a forced illustration where what Warren's saying is, I'm going to stop making the premium because I'm going to be taking cash value, but I won't need to take as much cash value as a personal pension because I don't have to make that premium payment. You can just run those in-force illustrations to see which one will be the optimum in that situation. It's going to depend on your age, how long you've funded the policy, and how long you got to tell us when you're going to die. I mean, it's that's
Well,
are
and
you going to die at 90, 95, 100,
be-
to do those scenarios?
because the thing that everyone doesn't realize until they're there, that hearing about it and experiencing it is two different things, is that policy does get more and more and more efficient the longer you've had it in force. And so there could be reasons why, as you're running those numbers and looking at them, it might make sense to continue paying the premium because the benefit of the new premium payment outweighs not outweighs reduced paying up and stopping the premium payments because maybe it's so good that the policy's been enforced long enough that it's really good for you to continue making those premium
Yeah, and
payments.
then the final one, and I don't want to get deep into this because once again, this shows how Warren understands all this and will confuse our listeners. But he says, but I want to recognize this also the situation where no more premiums can be paid due to MEC considerations would not an RPU maximize cash value growth. And the reason why it may maximize cash value growth is because the death benefit has been reduced. So that could be a situation. But when the death benefit is reduced, it also thwarts the dividends. So all that has to be taken in consideration. I want to stick though, and in this final question from the social media insurance bro, how do we deal with CFPs and RIAs who are anti-cash value towards anti-cash value life insurance towards
Hmm.
their or potential clients, usually on LinkedIn. Listen, uh, Nelson Nash once said, if you are talking to a fool and you're trying to make your point and they don't listen and you continue to talk to that fool, you now have two fools.
That sounds like
Uh,
Proverbs, actually. It uses the word fool way too many times.
well, it may be because Nelson was big into Proverbs,
Yes.
but um, and so it's frustrating, but it's like time. I used to say this all the time. It's like trying to tell a narrow-minded person they're narrow-minded. They're not going to listen because they're narrow-minded. So I know it's frustrating, and I used to be just in the same. I used to try to get my point across, so on and so forth. But I've realized now that I make my points, and if they don't really see the bigger picture, then I just stop making my points and I move on to the next person. There's going to be somebody there that's going to help. What I always get frustrated with is CFPs. CFPs that are supposed to be like the top standard of of a financial professional. And they actually have a section on the CFP on how life insurance works. And yet you talk to any I'm not gonna use an absolute. CFPs that I have talked to have almost no understanding of life insurance and how it works into a plan. Their idea is that it might just be term insurance because they are not looking at life insurance. They're only looking at it as far as a rate of return. They're not looking at it, and then they're supposed to be looking at a holistic plan. That's what a CFP professional is supposed to be doing. But they're only looking at it from how do you build this pile of money? And they're looking at the returns, the internal rate of returns on this. And so my advice is just stop talking to these people and talk to the people that want to actually think differently.
Couldn't be said better. So let's come back in the remaining, we have about 5 minutes left. Is that okay with you when the timing, Bruce?
Sure. Sure.
So let's talk about reduced paying up and the infinite banking concept. So if you are using infinite banking, you're storing capital where you have access, you have guarantees, you have liquidity, you can tap into that capital, you can keep that capital growing, the cash value. It's growing with dividends and interest, or let's say guaranteed interest, non-guaranteed, highly anticipated dividends, and you have this death benefit. So I like that. I personally like that a lot. I want to fund as much as possible towards this infinite banking policy, multiple policies, infinite banking system, because I want access to cash on a guaranteed basis and I want to be able to have the death benefit. I love those benefits. So I want to have continuous premium contributions. I want paid up additions. I want long-term compounding. And if I needed to pull like the parachute, if I need to pull the parachute of RPU at some point, I know that's in the back of my mind. We could do that if absolutely necessary. However, that's going to stop the flow of capital into this infinite banking system. That's going to eliminate the future paid up additions, the future cash value growth that I was wanting to continue building. And I don't even know if we want to introduce this word because it can be a volatile word, but it reduces the long-term growth velocity. It means that I can't grow as fast. It means that I can't continue expanding the reach of my cash value as much as I had wanted to in the past. And so that's where we're talking about idling. It's almost like this growth of cash value and liquidity I had in mind, I'm pulling the ignition on that, the key out of the ignition. I'm idling that trajectory by pulling the RPU cord, by pulling that parachute. So I still have the car, I still have the cash value, I still have this thing I can rely on, but it's not really moving forward the way that I was hoping to continue expanding the capital that I'm banking with. And so, Bruce, I really see that somebody who is using infinite banking would rarely want to use a reduced paid up option. Can you talk about really why they in addition to anything I already shared, why infinite banking
Well,
would have
the contracts are are engineered by actuaries to in today's products and most of today's products to for the cash value must by contract equal the death benefit at age 120 or 121, depending on the contract. So if it must equal the death benefit at that time, the higher you can make the death benefit along the way, the higher the cash value must grow to equal that. So that is one of the really, if you reduce pay up, you're reducing the death benefit. So you're really thwarting not only how much you can put in cash value wise, but how much growth can be. And then the final thing, and it's hard unless somebody really experiences this, because even if you see it on an illustration, I don't think it impacts your life. But when you have contracts, as long as I have contracts from the 90s, um, even the ones that I have the last 15 years, even the ones I have last 15 years, if I make a premium payment right now, within 30 days, more than my premium payment is available. It's like you have a money making machine. And then the longer the contracts, it might be 2 to 3 times it increases the cash value by how much you put premium payments in. And although part of that's guaranteed, part of its dividends are not guaranteed, but they're highly probable. I mean, there's not another financial tool that you can use that has that kind of safety net where you can say, man, I put this $30,000 premium in, and at the end of the year, my cash value is going to grow by 50,000. I mean, it's it's not the end all of be all, but it should be the starting place of all your capital.
that is a quotable. It's not the end all be all, but it should be the starting point of all your capital, starting place of all your capital. A couple things I want to comment on that. We've got some new comments in the chat. Bruce, do you have another couple of minutes if we
Yeah,
go long?
yeah, yeah,
Okay.
yeah, yeah.
So when you mentioned this idea of the death benefit and the cash value has to equal the death benefit at the end of the contract, age 121. I'm going to take you back to something I've used to see mentally that idea. It's called the banana curve. So if you have your death benefit, that's a line starting here, growing like this over time, ending up here, your cash value starting down here, also growing to have to end at that same end point here. So if you reduce where the death benefit is going to end up, instead of from here to here, if this is the death benefit growth, your cash value is also following a lesser curve because that end point has to be the same. Meaning cash value, death benefit. If you can imagine like strings coming from death benefit here, cash value at the start of a policy up to this end point, if you move that end point up higher because the death benefit's higher, your cash value is going to also have to grow faster and more powerfully at the end to be able to get those curves to equal the same point at the end. The banana curve is what helps me understand that. That's the two parts of an endpoint coming to the end, same curve. Bruce, we need to talk about the big picture and also why policy design matters, but we've got some questions here. Um, I do love that. Where was it? Fritz says RPU reduced pension unnecessarily.
Rich,
Um,
Rich has always got a good word.
love that. And then Warren had another question in there, but 1689 for the win just jumped on, but would an offset be more superior to an RPU for continued cash value growth? Bruce,
Yeah,
offset
they
is
all
not a
said
word we used today.
right. Offset is a word that's commonly used, but it's just using PUAs or dividends to offset the premium payments. So it's the same thing we've been talking about earlier. Yeah, and like he said he just jumped in, but we covered that in first. Maybe you can go back and watch the first part of that. Thank you for jumping in today.
Excellent. Okay. So why does policy design matter so much? Because a well-designed policy reduces, not to play on words too much, reduces the likelihood of needing to use an RPU, needing to reduce pay up. So some things to really look out for in a policy design that is sustainable, that can allow you to weather those potential future changes, are a sustainable base premium. And when I say sustainable, I mean you're being realistic about the commitment that you can make. It's not exaggerated. It's not saying, well, I've got a bunch of cash right now today that I can put this huge amount of required premium in, but it's being realistic about something that you can commit to for the long term. You have paid up additions riders, you have term riders where appropriate, and you have early liquidity balanced with long-term growth. And that simply means the ratio of base premium to PUA. Bruce, anything you want to add or clarify on that?
Well, what I found that people are most surprised at is when you show them a reduced paid up, is how much the death benefit actually has to reduce for it to be paid up. And the reason for that is what you were just talking about, policy design. So if you have a term rider on it that actually allows you to put PUAs in, then that term rider has to be substantial because the base policy is not very large. Then what ends up happening is not only when you are RPUing the base part of it and the PUAs, but the term rider falls off the contract. So if you have $2 million death benefit and you have 500, $700,000 of that is term, and then also you've used your cash value in the form of a loan, and your base was not very high, then all of those play into a factor where that 2 million, you only have maybe $80,000 of cash value left, and you want to RPU it. That 80,000, depending on your age, may only support $150,000 death benefit. And people are like, "What? I don't understand. I've been paying for this." Well, yeah, but they were planning on you paying the entire contract, and they were levelizing those premiums the entire contract.
Mm-hmm.
And so you stop paying premium payments, then you don't have as great of asset anymore, and it lowers the death benefit.
So I would think in that concept of making sure you have the right ratio of base to PUA, a good policy design would do two things. It would not over rely on a small amount of base and a high amount of PUAs with like what we would call a skinny base, because in that case, your death benefit is not going to be high, very high from that skinny base. And when you reduce pay up, you're going to reduce a huge amount, a majority of your death benefit. But the other side of things would be not making a 100% base policy if you can't commit to that payment, because that is the guaranteed or required is the word I'm looking for, the required premium payment. And so you want to commit to a an appropriate amount that you can commit to long term in terms of your base, and then have an appropriate distribution of base and PUA to have a sustainable policy. Finally, really kind of the bigger picture here is that the power of whole life insurance, I see the power as being the guarantees. I I have guaranteed cash value. I have guaranteed amount of premium. I have a guaranteed death benefit. But in addition to those guarantees, I also have flexibility. And I don't think that I it's it's not valuable to over rely on the flexibility and say, well, I don't really need to pay my premium. That will not lead you to the success with life insurance and with infinite banking that you are intending when you set up the policy, because we don't want to be afraid to capitalize. We need to value capitalization and putting the money into the contract so that it can work, but knowing that I have flexibility if I run into a circumstance that I just can't make that full committed or the full premium payment that I had committed to, allows me to have a lot more peace of mind as well. Which means if I do exercise any of those non-forfeiture options, or even to the point of needing to RPU and needing to reduce pay at my policy, I still am not losing everything. My coverage is adaptable and I can have a policy that survives my life transitions. It can be something that allows me to live life and is flexible around those life transitions. So you can, I think just going back to the airplane example again, it is really powerful to know that I have the ability to grab the oxygen mask and get the life preserver. That's not going to save me if the plane does go down necessarily, but knowing that I have those safety measures, there's a exit door if I need to get out, that allows me to have this safety net to benefit from knowing that those options exist, the same way that an RPU option gives me that safety of knowing that I could exercise this option, which then just that safety of knowing that usually means I probably won't have to. Bruce, anything else we need to say here? We've had a lot of.
No, I want to thank JJ. I haven't heard from him in a long time, and he says people have a hard time of mentally correlating a drop in the large death benefit with the non-payment of their contractual premium base when they choose the RPU. I agree with that 100%, JJ. And even very intelligent people, very logical people have a hard time um, putting those two things together. The final thing I just like to say is this is a contract. So you need to utilize all the provisions within the contract. And those provisions are in there. It's a unilateral contract, and you get to determine which of those provisions to actually utilize at any time. So take advantage of it. But the last one you should probably utilize is the RPU.
Excellent. Thank you for being with us today. I hope this episode was helpful and clarifying for you. And if you are trying to make decisions about starting or growing or expanding your infinite banking system, using family banking, using life insurance, or you have questions about any of these things, in addition, you might have questions about optimizing your money or some of those strategies that Bruce mentioned earlier, where maybe there is a more strategic way to structure your financial choices that could give you much better options than currently what you're seeing. We would love to be a part of that discussion and a part of that solution for you to be able to help you see the best way to optimize your financial life. You can book a call with our advisors at themoneyadvantage.com, and we look forward to being a solution and serving you. If also you are interested in thinking about how to ensure that you craft and create a legacy that lasts, and you want to make sure that you're infusing your values into the legacy that you're leaving to your children and perhaps even to your grandchildren and beyond, we would also love to talk to you about your legacy planning. And you can go, actually, I don't think I have a link on that. We'll make sure that you have a link to book that call in the show notes. Thank you so much for being with us today. And in closing, please remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.